Welcome to Xcelerate with Sean Redford. The Xcelerate Xcast is designed to provide Experior agents with simple, repeatable, and profitable strategies for you to grow your business. We will share ideas on how to identify ideal target markets and new opportunities, improve your conversations with proven scripts and storytelling, and finally, we'll also meet with industry experts and our partner companies to ensure we're up to date with the newest technology and insights, all so you're able to accelerate your growth. We hope you enjoy Xcelerate with me, your host, Sean Redford. Hello, Experior champions, and thank you for joining us for today's episode of Xcelerate with Sean Redford. I am so honored today for us to have as our guest Dr. Rodney Mogen. He is the brokerage manager at MassMutual, and today we're going to be talking about one of his several client sales ideas, G.O.A.L. G.O.A.L stands for Gift of a Lifetime. We're talking about life insurance for the juvenile market, locking in their insurability, offering an opportunity to build cash flow, but also having that uncomfortable conversation with families, with parents, with grandparents about the risk should something, heaven forbid, happen. I tell you, Dr. Rodney Mogen is quite the overachiever. He's got doctorates in economics, business administration, and financial planning. He's built a huge presence as a top wholesaler, winning Wholesaler of the Year 3 times. He's been active in so many ways in terms of bringing awareness to autism, children with disabilities. He's testified in front of U.S. Congress and Senate committees, as well as several state legislatures regarding small business financial issues. I tell you, this guy is an overachiever. I am so proud, so honored to be partnering with MassMutual, with Dr. Rodney Mogen, and I'm excited to share my conversation with him today so that you can have better conversations with your clients about the importance of insuring children early. So thank you for joining us today. I hope you enjoy the conversation. And welcome, Rodney. Thank you so much for joining us today. You know, we're excited about, and I'll still say it's still a growing relationship with MassMutual. We've had, the contracting and this arrangement in place, this partnership in place for a few months now. But I mean, let's face it, it still is just in the infant stages. We're still just growing this, but I really appreciate you taking the time to join us here today.
Well, Sean, I'm excited to be here, and thank you so much for having the opportunity for me to be here with you.
Oh, thank you. So, before the call, we were talking about, there's a lot of opportunity, a number of topics that you and I can discuss. And as I said, having been in your shoes for several years, I said to you that I really think we're cut from the same cloth because we don't care about product. It's never about the product. Every company in the marketplace has good product. But I think what differentiates the support that we get from our wholesaling partners, from our partner companies, is how can we take these product solutions and actually turn them into sales opportunities, turn them into better conversations, better experiences with our clients. And that's where I think you stand out in a number of regards. And I'll get through that in a minute, but I wanted to highlight something you sent me early on in our relationship. And it was your ideal client sales ideas, where you outlined sales ideas for, supplemental disability, long-term care coverage, business owners, taming the market, which, we'll have to do a second podcast for that one. I'm excited to talk about that one. But today, I'd really love for you to talk to us about one of your ideal sales ideas, and that is G.O.A.L. What does that mean, G.O.A.L, G-O-A-L?
Yep. So G.O.A.L stands for Gift of a Lifetime, Sean. And the reason why I call it Gift of a Lifetime, and I actually run with this a lot, I do a lot of these types of policies, is this is actually for doing juvenile life insurance. So let me kind of take a step back of covering that whole market for a second. Juvenile life insurance is sometimes a taboo thing for different people because, well, why would I want to insure my kid? That might actually create I say a bad juju, but they may say something else. Or my child doesn't really have an insurance need. Or, well, if I get insurance on my child, aren't I being greedy because now I just want, if they die, I'm going to get this death benefit. And I understand all of those comments and ideas, but that's why I like to talk about it as a goal, gift of a lifetime. And it's gift of a lifetime for 3 different reasons. The first one is you are giving that child, and I'll talk about how it could be parents, grandparents here in just a second, but you're giving that child a gift of life insurance, cash value life insurance to be more exact. And the reason why that's a gift is they now have a permanent policy that will follow them for the rest of their life. Yep. Number 2 is you can actually help, depending on how you fund it, depending on how you structure it, you could actually, and again, this goes to it being a gift. Remember, we're talking about cash value life insurance. So maybe at age 24, maybe they still have some student loans they need to pay off, and you can take money out of that cash value, pay off those loans. Maybe at age 30 or age 35, they want to put a down payment on a house. You can pull some money out for that down payment. Maybe when they're in their 50s or 60s, again, they have this policy their entire life. Maybe they need to send their own kids to college. So they just haven't really. So you laugh, but that's the gift is It's really setting up. You can use it for a lot of different things. I've been in this industry for over 25 years, and this is a strategy I have run with for 25 years. And I have clients who I set this up with for their kids, and then now they're setting it up for their grandkids because they've seen the advantage of what it's actually done. In addition, remember I mentioned there were 3 things that you're giving this gift. And the third one is probably, in my opinion, the most important one. And that is insurability. And here's what I mean by that. So we can do a $100,000 policy. We can do a $1 million policy. There are some rules and regulations around things. Okay, so it's not unlimited, but you can do some different things there. But what we're seeing, especially here in the U.S., according to the Social Security Administration and also the Department of Health and Human Services here in the U.S., is that 25 to 30% of juveniles that turn age 18 are turning 18 with lifelong illnesses that knock them out from getting life insurance.
Wow.
LIMRA, the Life Insurance Marketing and Research Association, actually pegs that number from 2022. They pegged that number closer to almost 40%. So this could be juvenile diabetes at type 1. This could be lupus. It could be different types of autoimmune diseases, different things like that. Something that a lot of people don't know about me, I'm going to share on today's podcast, is I'm autistic. A lot of times, autistic individuals cannot get life insurance once they get a diagnosis. Now, it depends on severity, depends on different. I do have my own life insurance policy that I got as an adult. But what if your child got that diagnosis when they were 10? Well, more than likely, depending on the severity, depending on all these different things, they may never be able to get life insurance. Now, they may be living a, like I am, productive life, successful, all these different things, but they can't protect their family. Mm-hmm. So that's why I think it's really the most important gift is if you can get it when they're 1 or 2 or 3, 4 or 5, before they have any of these diagnoses, before they have any of these other different things, you now actually can add a rider on them. Every company's a little bit different. At MassMutual, and this is another product I'll talk about for a second, but there's a rider we call the Guaranteed Insurability Rider, or GIR. And what this will allow is you can get 8 different tranches starting at age 18 of additional whole life cash value based insurance every 3 years. So 18, 21, so on and so forth. And you're going to get it at, locked in rates, all those different things, no medical underwriting. You're going to be able to get those additional policies. So those 3 things are, to me, really important. That last one is probably the most important just because we know so many people are turning from juvenile to adulthood with serious health conditions that either limit, or prevent them from getting life insurance as an adult. Now, you're probably not going to get them a $5 million policy. So we're not talking about that. Most of the policies I do are generally 100,000, 50,000, 250,000. Couple things to understand about doing it is the parent does need to have life insurance themselves or be applying for it as well. Every company is a little bit different about how much they need to have. Really, at MassMutual, we actually are looking at it for you have to have at least the same amount of life insurance you're applying for. Yeah.
Assuming you're insurable yourself as a parent?
Correct.
So
but
would you have exceptions if the parent is not insurable?
Yeah. So a lot of times, I mean, all they're looking for is if they actually have life insurance in place. So if they're at an employer that has life insurance and they've got 50,000 or 100,000 in group term, that will count. They just need some type of insurance in place. And it just has to be one of the parents. It doesn't have to be both of the parents. So if there are, and I'm saying parents, it could also be guardian, whoever the guardian is.
Sure.
To continue the sales idea, what we're seeing where this is really, really impactful is it's not the parents doing it for their kids. It is the grandparents doing it for their kids.
Yeah.
And I just completed a situation where grandparent has 12 grandchildren and 2 great-grandchildren, if you can believe that. It's interesting because one of the grandchildren is only 16, but she has 2 kids that are 1 year old. So you can tell she had it a little bit early. So that's where you got the great grandchildren in there. But the grandfather died and left a life insurance benefit. And so what she wanted to do was she had enough money to begin with. So rather than just set it aside, she decided she wanted to create a legacy for her grandkids and great grandkids. And so what she decided to do was split up that money and is paying 10 payments each. So 10 years for each of them. We've set it aside to do that. And she's bought them insurance with this guaranteed insurability rider, so on and so forth. And we're getting each one about 100 to 150,000 because it does depend on age and gender. There's some variability there, but each illustration is actually looking really, really good. Where some of them in their late 20s or even early 30s will have enough, in today's dollars to put a down payment on a home or pay off education or different things like that. And that's what she wanted to really set up. What was interesting is I put this in place in February of this year. I just got a call from the broker I work with who this is his client. And he just called me and said, "Hey, you remember the case we just did?" I was like, "Yeah, blah, blah, blah." He's like, "Well, she just told me her granddaughter, who is 8 years old, just got diagnosed with leukemia."
Wow.
And the relief from the client to the broker, and the broker was telling us, she said, "I am so glad because I know she's going to get through this. I know she's going to be fine. But I also know she's going to have a really hard time ever getting life insurance again." And we got about 200,000 for, like I said, 100 to 200,000 for each one. And for this one, it was about 200,000 because of age. She's like, she at least will have $200,000 in permanent life insurance for the rest of her life. But she has the opportunity to add an additional 800,000 in permanent life insurance over the 20 years when she becomes an adult. So I have hopefully protected her family in a way that no one else can. And this is from an 83-year-old, who's seeing that. And we had to get the parents involved. We had the parents because they're guardians. The parents had to buy into it, but it's her money. She could do whatever she wants with it. But that parent actually has now said, "Oh my God, I see exactly why this is so important." Yeah. And so this is to me, it's an easy concept, especially when you're working with retirees, pre-retirees, where they do have grandkids. You don't eliminate the parents at all. Obviously, parents will want to do it also for their kids, but where we see it generally is from grandparents wanting to give this as a gift. That's why we call it gift of a lifetime. But It's usually with assets that they don't really need, won't really use.
That they're going to end up giving to the grandkids anyway.
Exactly. And it's done, especially in the US, it's done where you don't have to worry about generation skipping. You don't have to worry about different estate taxes, things like that. Because they're literally getting it as a gift to the grandkid as a premium for the most part.
Yeah.
This is where I like using whole life, because we can actually shorten the payment periods and have guaranteed paid up policies.
Yeah. So let me interject for a minute.
I'll pause for a second.
Yeah, because I mean, there's a whole bunch of information over the last 10, 12 minutes that I want to kind of unpackage for our audience. So first, I mean, I agree with you wholeheartedly on the 3 reasons why you want to do this. I mean, look at case in point, COVID. You know, it really affected a lot of people in a number of different ways. It got them thinking about their mortality, for one thing, but it also made us all acutely aware that this is a global economy now, and you don't know what the future holds in terms of health, right? I mean, it's bad enough that teens today are suffering from anxiety and depression like no time before in history. Smoking has come back like wildfire just because of vaping and the fact that it tastes like bubblegum apparently now for kids to smoke. Drug and alcohol abuse, again relating back to mental illness that many of our kids are dealing with. And Rodney, it wasn't that long ago since we were young and stupid and made bad decisions. Those lifestyle choices can all have an impact, not to mention family history. So all of these things, your clients, parents, grandparents are not aware of the impact on their kids. So creating that urgency, having that conversation early on in a positive way, is really important. But I would also add one thing. And as wonderful as cash value life insurance is and all the wonderful things that you can do with it and locking in the low cost of insurance and insurability, that is all wonderful. But if you've been in this business, if you've been alive long enough, tragedy strikes. And that's what we are in the business of protecting, is transferring that risk and being prepared for tragedy when it comes, if it comes. And, I often tell our agents, it is your job to have the uncomfortable conversations, to talk about death. That's your job. That's why you get paid the big bucks. And, the reality is people don't wake up in the morning wanting to buy life insurance. You have to convey to them the importance and the responsibility and the urgency of doing so. And I've been unfortunate to know a couple of families who have lost their children at young ages. And the devastation that has on a family, whether there's other siblings involved or not, is irrelevant. The devastation to a family is unbearable. And the last thing people want to do is go back to work. So yes, they may qualify for disability insurance and be able to replace some of their income, but how long is it going to be? How long is their long-term disability through their employer going to last? How soon are they going to want to go back to work? And what is the quality of their life going to be afterwards? The question always, when it pertains to life insurance, could cash help? And I think the answer is always going to be yes.
So Sean, one of the things that you highlighted there is, you said siblings. So what if they do have siblings and that cash, unfortunately, I've been in the same situation where I have actually both lost a good friend when I was a child, but I've also had a lot of, not a lot, but I had a couple friends who have lost young children, but they have siblings. Well, I think a lot of times a lot of people don't understand the effect that it really does have on children. So that death benefit, as tragic as that is that you lost a child, it can be, like you said, it can be used to have.
It can save the family.
It can save the family. It can let you stay home for a while. It can do some different things, but it can also pay for therapy for those siblings. And, especially right now, I have a friend, unfortunately, he just lost his 17-year-old son. And I'm bringing this up because he actually is a client of mine. And I did get, when his son was 1 year old and he has 4 other children, we got life insurance on all of them.
Mm.
And it was a $200,000 policy for each one because he wanted a specific death benefit. But the son had been bullied for the last 5 years, especially on social media, things like that, and finally, had enough, for lack of a better term, committed suicide. He's had the policy for a while. Here's a 17-year-old star of the baseball team, about to go to college. All these different things. Outwardly, you think it's there. It was so devastating to the family. When I delivered the check to my friend, this $200,000 check, his wife, his mom, his mother-in-law, and him all hugged me because they were able to. Now they're like, okay, neither one of us have to go back to work right now. We can spend a couple of months. They do have disability, so they both file claims as well, so that they could spend 6 months to a year to spend time with the other children and have this quality time.
Yeah.
But they actually were using about $50,000 of the proceeds to set up a foundation that will live in honor of this individual, and then they're using another $20,000 to pay for therapy for his siblings. And they still have money left over to do other different things. They're going to go on a trip. It sounds weird that we're using the death of our child and we're going to go do these things, but it's actually from that tragedy piece, it's turning tragedy into something positive. And that's where it can come in.
Absolutely. I mean, it's therapy for the family. I mean, most families are torn apart. The two people that I've known that have lost their children when the children were young, the marriages fell apart. Two of them. One of them was able to withstand the trauma, but it's absolutely devastating for a family. Now, the other thing that you mentioned there, which I love the word, is legacy. And you were talking about it in context. Well, twice you've actually mentioned it. And first in context of grandparents. And when I think about that, you hear story after story about people on their deathbeds and looking back on their lives and, asking themselves, did I work enough? Did I earn enough money? Did I have enough of the things? And it's never that. It's about the quality of the time and the relationships that they spent with people. That's what they're thinking about. And that's what they're wondering, did they do enough of? And this is where they start to think about the legacy that they're going to be leaving behind. Are they going to be remembered after they're gone? And this is part of the conversation that I recommend agents talk to grandparents in particular about, because nothing in the world is more important to them than their grandchildren, right? Forget about the parents. They're secondary now. It's all about the
They've already screwed them up.
Exactly. They're all messed up. Everything in their life is the fault of the grandparents now. So skip them, go on to the grandkids. But it's true. That's who they genuinely care about. And then you brought it up again in the story, the situation you just mentioned, where the family set up a foundation to create a legacy for their child. Because again, we all want our lives or the lives of our children to have meaning and have purpose. And we often don't take time to think about this because life is busy, right? We've got too many other things on the go. Again, this is where I think agents, advisors can add incredible value to have families think and just have these conversations openly about what do they want to be remembered for? What values do they want to pass on? And I think that was the other point that I wanted to bring up earlier on with, the reasons to insure individual children is because you're laying that foundation of security and the value and the importance of life insurance to the family. So you're setting those values that hopefully are going to last for generations to come.
Yep. That 83-year-old that I was talking about, she never went to college. She, you think about the age, it sounds about right. She's female, never went to college. She actually never graduated high school. She grew up in a small farming community. So all she had was a 6th grade education. Now, my little joke is my grandfather was also a farmer, and I've seen his 5th grade final exam because that's all he had was a 5th grade education. I don't think most college level people could pass his 5th grade final exam. So, so I don't know if just only having a 5th grade education is an insult or accommodation there. But now she has the ability. Now all her kids have gone to college, but now she's ensuring that her grandkids can go to college. Hopefully, maybe her great grandkids can go to college. She has this money set aside for that, and think about that as the legacy of grandma so and so ensured that we would continue to keep growing our family because it's just so important to her. So
yeah. And before we start talking about MassMutual and how its product solutions can be a great tool in this concept, in this strategy, I want to also remind our agents and our audience that when it comes to articulating the solution to the client, you're not focusing on the death benefit. You're not focusing on the cash value. You're focusing on all the solutions, all of the opportunities, all of the risks that your solution is able to mitigate. And you nailed it at the top, talking about getting that low cost of insurance in place, locking in their insurability, because was the number 25 to 30% of 18-year-olds are uninsurable. LIMRA says up to 40%. That's astounding. Yep. And I think a lot of that has to do with all the crazy stuff that adolescents and teens are having to deal with today. So, that's unfortunate. But what are they going to be able to use the cash value for? Whether it's emergency savings, buying the house, getting married, paying off their mortgage, or supplementing their retirement income. And then again, the setting up the financial security, instilling the values, and leaving a legacy. I mean, what a powerful solution from an insurance product sale, right? So I love, thank you for, helping us to articulate all of this. So let's talk a little bit about MassMutual. I mean, MassMutual is massive, so you've got credibility, you've got clout. Tell us about MassMutual, and then talk to us about the solution that you would recommend based on this strategy we've been talking about today.
Yep. So MassMutual has been around for over 173 years. We have we're a strong whole life company. We have a strong dividend currently right now. And I hesitate to say right now, just because we've had one for the last few years where we've been at the top of the industry, but dividends can change on an annual basis. Sure. However, Mass is very, very conservative with their dividend, and they're very focused on providing a top quality dividend interest rate and dividend each and every single year. And they've always paid a dividend in the 173 plus years they've been around. I like to say that MassMutual is a conservative, progressive underwriting life insurance company. Okay. And what I mean by that is we are going to be conservative. We are going to make sure that we can always provide a dividend, that we are always going to be there to pay our claims and do all those different things. However, our underwriters are really, really strong at trying to make the best offer first. In fact, I was just on a call with Office of the Chief the other day, and that's exactly what he just reiterated to all of his underwriters: best offer first. So those are some of the things that, that's what I mean by the progressive piece, is that we try to do it. Now, doesn't mean we're going to meet it in every case, but that's why you also want to work with juveniles. It's a lot easier to get juvenile cases through and a lot quicker. Yeah. But the other thing is we are a life insurance company. So that, while we do have disability and we have annuities and we have other different products, that is our core, is whole life insurance, providing that dividend. We have term and have other different things, but that's what leads me into the G.O.A.L strategy. And that is the fact that our whole life products, we have a vast array. We have from an 8-pay all the way to a pay to age 100. So when I'm utilizing the G.O.A.L strategy, generally I'm going to do either an 8, 10 pay. Sometimes though, like I just did a couple today where we did a 20 pay because the client wanted to pay for 20 years. And sometimes if we're really trying to stretch it out or trying to look, because sometimes, sometimes the client wants a certain death benefit. Sometimes they have a limited budget, so they don't always meet together. So there are ways where maybe we do it to a pay to age 65. Now, you're probably going, well, that means the juvenile is going to have to start paying those premiums. And yeah, They might. But what I have seen, and I have actually sat with clients who had a MassMutual policy that their grandparent bought them when they were 2. When they died, they turned it to their parents. The parents kept paying premiums a little bit. And then now they're our age, Sean. They're in their mid 40s. I'm 47. And now their parents have just turned over the policy to them to keep paying the premiums. They've got upper 6 figures of cash value in there. These are policies they didn't even know they had.
Yeah.
So think of that advantage there, because people just kept paying it, just kept getting, they just kept writing the bill. They totally didn't think about it. And then, parent died, they passed it on, so on and so forth. So I've heard those stories, but that's where, generally get back to it. That's why I like, generally doing a 10 or 20 pay to get them right to adulthood or just out of it. And then you don't have to pay it, because with MassMutual, if you do those short pays, if you pay all the premiums at, let's say, 10 years, then that policy is now contractually paid up for the rest of your life.
Yeah.
Even if you pull money out, it's contractually paid up. Now you may have to pay back the loan or something like that, but it's going to be a guaranteed policy.
Yeah.
So that's why I like that 10 or 20 pay. But like I said, if we need to adjust things, we can do maybe to a pay to age 65. In fact, I was helping one of your agents and brokers today with that, where we were looking at, do we do a 20 pay or do we do a pay to age 65 to try to actually fit the budget with the death benefit they want? And we end up going with that pay to age 65.
Mm-hmm.
The other strength for MassMutual is guarantees. So that G word is a hard one to use in our industry, right?
Yes.
But when it comes to whole life, it's really the only insurance policy with true guarantees inside of it. There are different rules for it, though. Depending on different products, you're going to have some different guarantees. So some might be 2% with Mass, and they can go as high as 3.75%. And that's going to affect what the premium's going to be. It's going to affect the death benefit. So if we're really trying to maximize cash, that's where I'm going to use our 10 pay, because that guarantee is only 2%. But the agent I was working with from Xperia earlier today, they are from India. All their clients are from India. The guarantees are extremely important to them. So that's why we went with the whole life 65, because that guarantee is 3%. And so with that, now they have certainty of, okay, this is how much I'm putting in. I know in 10 years we can pull this out if we need to, but we also have the dividend being paid this. So I think really it comes down to, and Sean, I think you hit on this too, you're not just selling a death benefit. In fact, if you're doing this strategy, I wouldn't even really talk about the death benefit, but I would talk about all the different things that come along with it. And I think one of those things is, if you understand what your client's needs are, maybe that guarantee or that safety is extremely important to them. And so that's where you can really take a look at this and have some fun with it, and really, work with those clients. And like I said, they're usually pretty simple implementations. They go quickly, but for the most part, you're providing really that goal or that gift of a lifetime, that legacy. So hope that helps.
Yeah, no, that was great. And I was just looking back at my notes from our conversation here today, and I had a couple of questions. The first one had to do with gifting. And, I being a Canadian and just, getting more familiar with tax laws and other regulations in the United States, is there a limit how much premium can be paid as a gift in this strategy?
Yes and no. And I say that for this reason. So there are some in the U.S. there are some specific gift tax limits, or what we call gift tax exclusions, where you can give up to $18,000 a year in 2024 per person. So let's just use that grandparent I was talking about. They can gift $18,000 in premium dollars to each of their grandkids. So there's no major limit. They can do it per person per year, and it's usually indexed up. Now that might change depending on who's in charge in the U.S. Sometimes those rules change.
Yeah.
But the better thing to really think about is, and this is why I said yes or no. So there really isn't a limit because most of these policies are not doing an $18,000 premium.
No.
Okay. Very rarely are they ever really that high. Okay. But that's where the limit really comes in, is it's really about how much death benefit you're buying for it. So, if you asked the question earlier, well, if the parent only has $100,000 in death benefit in force, because maybe that's all they can qualify for, or maybe that's all they could afford, or whatever, or they can't get any more because they're no longer medically eligible. Well, that means the most death benefit we're going to be able to get is $100,000. So it doesn't matter that grandma can give $18,000. It's all we can get is $100,000 in death benefit. So whatever that premium is going to be, that's what it's going to be. So it's kind of unlimited, but this is not something where it's going to be $100,000 annual premium case. These are smaller cases, but the impact of them are extremely important.
Yeah. Okay. The other question I had, and this is something I caution families about in Canada, and because we were talking about cascading or transferring ownership of this policy from one generation to the next, right? And the risk there is you eventually transfer ownership to, let's say, the grandchild in their 20s or 30s at some point, and they're in a relationship, they're married, and the marriage breaks down. Well, if the policy is in the child's name, if it's owned in their name, that it's an asset, right? And I assume it's the same case in the US as it is in Canada. So that's an asset. So usually I caution families to avoid either transferring ownership for as long as possible, or use a trust if necessary to help protect that asset. And I was just wondering if that was the case as well in the US, and if you would recommend anything different.
Yep. So I'm not a lawyer, but I will highlight that it is about the same in the US. However, what makes it even more complicated in the US is it is different by state.
Lovely.
Yes. So I domicile in Texas, and so I'll just use Texas as an example. Cash value life insurance, if you are the owner and the insured, that cash value life insurance is not subject to creditors. It is not subject to federal taxation. It is not subject to a lot of different things. Also, because it is Texas, if it is something that you brought into the marriage, using your example, it is a protected asset as well, even though we are a community property state. Okay. And because it's something I brought into it or was given, even if I got it after I was married, it was something that was already in existence. I just wasn't the owner of it. So that is actually protected. Now, other states, it's not always the case. So that's why I said it can vary by state. So always you want to check specific state laws. The other thing is, remember, I kept talking about how you can use this for education costs. That's another nuance. So under something in the U.S. we call FAFSA, the Federal Savings Assistance, basically think student loans. With that, if you're going to a public university, cash value life insurance is not included. If you are going to a private university, as far as eligibility for student loans and grants, they do actually include cash value life insurance if it's in your name. So there are different reasons to not transfer ownership. There are different reasons to keep it in a trust. So that's where your agents, everyone here at Xcelerate, that's the value you provide to your clients to make sure they're set up properly.
Yeah. So do your due diligence. If you're going to sell this concept, make sure you are clear with those state laws, because these are important distinctions that you want to make yourself aware of. This was great, Rodney. I really appreciate your time and your insights and sharing all of this valuable information. And I'll also share with our audience. I also hosted an Xcelerate Unplugged session earlier on, where I talked specifically about the idea of insuring the lives of children. So just to reiterate, I'm a big proponent of this. I think this is important for the benefit of the family, the benefit of the child. And I'll admit, it's low-lying fruit. These are, to use a baseball analogy, these are singles and doubles, right? Any family with young kids should consider this if they've got the disposable dollars to do so. Mom and dad should be interested in locking in the insurability of their kids at that low cost. If they don't, what a great introduction to that next generation, that older generation, where you can provide this solution to the people that matter most to them in the world, but now show your value to a whole other group of clients within that family ladder. So I think it's a great opportunity for you to really add value to a family and to the client relationship. Rodney, before I let you go, did you want to say anything before we wrap up?
I do. If I could share one quick story based on what you just shared,
Absolutely.
I would love to do that. So I was in a conversation about 10 years ago with a broker I work with, and they're now one of my top brokers. And these are conversations I get into on a regular basis of, well, how do I grow my business? How do I find additional clients? Things like that. And he was working with people from mid 30s to early 40s. That was his age. That was the age of clients he was working with. And I happen to know he was having some trouble with his parents, with long-term care issues, with his in-laws. One of them had just died. They weren't financially prepared, things like that. I was like, have you talked to your clients about what to do with their parents? And he said, no. I was like, okay, well, that might be an uncomfortable conversation, but all of your clients have kids, right? Yeah. Well, why don't you ask them about what is the number one thing their parents want to protect? And so he ended up doing that. And so he ended up getting policies on all the kids of all of his parents, or from all of his clients. It ended up being, over 2 years, it ended up being almost 400 different policies. But the reason why I'm telling the story is every time he was referred to the grandparent to do the policy for the grandkids, he now had the opportunity to sit down and talk to them about their financial situation. He ended up rolling over just shy of $100 million of retirement assets. Okay. Into annuities, things like that. He was able to get long-term care. He was able to do some insurance policies, things like that. So think about how that transformed his practice. And, the thing about older people, they have time to talk to other older people.
So true.
And so today he gets 10 referrals a week from his older clients to do that strategy alone of just protecting the grandkids. And then it leads them to additional opportunities. And then, you need to talk to my kids because they got to get this stuff in place. So he's getting constant referrals. And this is 10 years ago. He has grown his practice. He now has 15 or 16 junior advisors working underneath him. So I just wanted to echo that point that it doesn't always work out that way, but that's one of the things we talked about. And so he focused on it, and it really blew up his practice.
It's so true. Beyond the weather and politics, what else do grandparents or seniors want to talk about more than their grandchildren, right? So I couldn't agree with you more. Thank you. Mic drop right on that. Dr. Rodney Mogen, thank you so much for your insight. We really appreciate you. We appreciate the relationship and partnership with MassMutual, and I look forward to having you on another call sometime soon.
Thanks, John. You have a great day.
All right. Thanks. You too, my friend.
Thanks for watching Xcelerate. I have another great video right here, so check it out. And remember, Xperior Financial Group is about real people, real ownership, and real change. Let us help you accelerate your growth.